Hi, this is Brian Resnitz, question and answer day, of course, and I had one of the questions that repeatedly comes in. It keeps coming in about interest rates and where do I see them headed. And also one of the questions that I want to kind of fold into this is, had a call from a gentleman on my radio show where the majority of his money was in the PIMCO Total Return Fund and another 50% of his money was basically in other bond income funds. So over 80% of this particular caller's question was, I've got 80% of my money in bond funds. 2013 wasn't good for me. Where do I expect rates to go, and what should he be doing with his portfolio? Ultimately this, most investors truly do not understand interest rates and how they impact your portfolio. When rates go down, bond values go up. When rates go up, bond values go down. So of course, if you own too many bonds and you own the wrong kind of bonds or bond funds, meaning the longer the maturity, the more your portfolio goes down when interest rates go up. He made a specific comment about the PIMCO Total Return Fund. While this is managed by Bill Gross and he's done a fabulous job long term, right now, Bill Gross, it's hard for him to really make a big change in that portfolio because where interest rates are headed, in my opinion. So at the end of the day, while interest rates did well for Bill Gross, meaning they went down, so the values of the bonds and bonds in general did pretty decent in the last 5 or 10 years, you're at the reverse cycle of bonds. So it's not necessarily Bill Gross or the PIMCO fund, it's the nature of where interest rates are headed. So what the problem with this investor and his question, he has too much money in bond funds. We don't recommend the PIMCO Total Return Fund because I think there's better animals out there for income-oriented investors. And one of the most important parts of an investment portfolio is called total return. That's growth and loss of principal plus the dividend you receive. So don't be lulled into, hey, I'm making a big dividend, but you're losing 10% in principal because rates are going up. Your total return could be negative. You want to look at the value of the portfolio. Is it going up or down? In combination with that income stream. And right now, again, my rule of thumb is extremely short-term, like floating rate type securities in a portfolio. Short-term duration protects your principal on rising interest rates. Yes, you make lesser interest, but I'd rather make, let's say, 4% total return than trying to stretch for an 8% income stream and actually losing 8% of my portfolio value, meaning I didn't make any money. So again, total return matters, and when you have bonds or bond mutual funds, when rates go up, values often go down, and they can go down quite hard. In fact, if rates go up just 2 to 3 percentage points over the next 3 to 5 years, bond investors could easily lose 30 to 50% of their portfolio, depending on the maturity level of the bonds they own.